The 2025 housing crash is no longer a forecast. It's here. In some cities, foreclosure numbers already look like 2008 on Fast Forward. Neighborhoods that were bragging about bidding wars 2 years ago are now full of price-reduced signs and dark windows. And this time, it's not just a story about prices coming down. It's about entire local economies quietly coming apart at the seams. The most dangerous part? How many people still think this is a small correction that will magically bounce back because real estate always goes up? Today on Across US 4, we're going city by city through 10 markets where home values are not drifting lower, they're getting crushed. In some neighborhoods, values have fallen by half or more. We're going to walk you through where the bubble finally burst, why homeowners are now cornered, and how the American dream has been quietly reclaimed, not by the buyer, but by the bank. If you're thinking of buying, investing, or relocating in 2025, this is not entertainment. It's your risk report. Make sure you're subscribed to Discover the Nation, tap that like button, and listen carefully. What you're about to hear could save you from a six-figure mistake. Let's get into it. Number 10, Cape Coral, Florida, when paradise stops penciling out. Drive into Cape Coral, and at first glance, it feels like a brochure that came to life. Canals crisscrossing the city, boats parked behind houses instead of cars, palms, sunshine, and no state income tax. On paper, it's everything an out-of-state buyer dreams of: lifestyle, water, weather, and cheap taxes. Then you open the real numbers. In less than 2 years, median home prices have fallen from around $465,000 to roughly $260,000 in many sections of Lee County. That's over 40% evaporated, and the trend is still pointed down. But the real wrecking ball here isn't just price, it's insurance. Florida's insurance system isn't under stress, it's breaking in slow motion. In Cape Coral, it's common now to see $8,000, $10,000 a year in homeowners insurance on a house worth $300,000. Think about that. You're paying luxury car payment money for the privilege of maybe being covered. One local couple bought at the top for just over $400,000. 2 years later, their premium doubled. Their home appraised for $100,000 less than they paid. Their property taxes readjusted off inflated boom values. Their dream move turned into negative equity plus rising fixed costs. That's not home ownership, that's a slow bleed hostage situation. Then there's Hurricane Ian. It didn't just rip roofs and flood streets. It rewired the entire local risk profile. Rebuild costs exploded, contractors ghosted jobs or folded. Materials spiked, government assistance crawled HOA dues, and special assessments still arrived on time. So now you've got houses sitting on the market for 6 to 9 months, sellers cutting prices in $50,000 chunks, not $5,000 waterfront homes, once listed near $899,000 finally selling in the low $400,000s if they move at all. Even the rental escape hatch is closing. Rents have softened, vacancy is up, but costs, taxes, insurance, maintenance stayed high. So landlords are squeezed from both ends. Cape Coral is no longer cheap waterfront. It's a live fire case study of what happens when climate risk insurance collapse overbuilding and speculative money all hit the same coastal market. If you live here or thought about buying here, drop your experience in the comments. Cape Coral is not just a local story, it's an early warning shot for every coastal market in America that still thinks the water will never touch them, financially or literally. Number 9, Austin, Texas. From darling of tech to overbuilt and overheated, for a few years, Austin was sold as the future. Silicon Valley 2.0, music, tech, culture, no state income tax, and keep Austin weird energy wrapped in venture capital money. Between 2020 and 2022, home prices didn't just go up, they went vertical. Median price from low 300s to around $575,000. That's a 90% sprint in a very short window. Now the reversal is just as brutal. By mid-2025, median prices have slid to just under $385,000. Roughly 1/3 of that boom is gone. And the correction is still working its way through the pipeline. What happened? 1. Tech cooled. Big employers trimmed staff. Smaller startups quietly folded or pulled back hiring. That constant inflow of high-income talent slowed. and so did demand for $500,000 boxes on tiny lots. 2. The skyline overbuilt. Those new glass towers downtown, many are now offering 2 to 3 months free rent. Discounted parking, amenity fees waived, move-in credits. Because vacancy is punching holes in their cash flow, owners who bought shiny new condos at peak valuations are learning a harsh truth. The resale market doesn't care what the sales office told you. 3. The cost stack exploded. Mortgage rates above 7%, property taxes tied to boom-era valuations, rising insurance, soaring HOA fees in some developments, higher utility bills in brutal heat. At some point, buyers simply walk away from the table. Homes once listed at $799,000 in East Austin are now sitting at $499,000, and even that doesn't guarantee a quick sale. Days on market used to be measured in hours. Now it's months. Add in grid worries every summer, water-strained infrastructure stretched by rapid migration, and a chunk of pandemic movers quietly exiting back to cheaper, calmer markets. Austin didn't just correct, it found out what happens when story fundamentals for too long. If you bought here between 2020 and 2022, you're living the spreadsheet in real time. Tell us in the comments how different the math looks now. Number 8, Boise, Idaho. When hidden gem becomes exposed. Bubble Boise used to be the quiet move, mountains, space, safety, and relative affordability. Then the coastal money arrived. Between 2020 and 2022, home values jumped more than 70%. People fleeing California and Seattle brought big city cash and remote jobs. Sellers realized they could name almost any number and get it. By 2025, that fantasy broke. In multiple Boise submarkets, prices have fallen close to half from their peaks. Median values that touched the mid-500,000s are now sliding back toward the high 200,000s and low 300,000s. The root problem? Prices detached from local incomes. Boise is not San Jose, it never was. But for 2 years, investors and remote workers treated it like a cheaper Silicon Valley annex. Then, tech firms canceled relocation plans. Remote work tightened. Some fully remote roles were cut or pulled back to headquarter states. Wage growth did not keep up with home price growth. You're left with locals priced into bubble mortgages, out-of-state speculators holding negative equity, new subdivisions on the edges of town, half full, built for demand that no longer exists. Foreclosures are starting to appear. Distressed owners who thought they could flip in a year are now swallowing six-figure losses. Some of those dream houses with a view are now bank-owned assets. Rents, they've softened too. Vacancy up, concessions up. But investors are still stuck with higher rates, higher taxes, higher insurance, higher maintenance costs on newer builds. Wildfire risk and shifting climate patterns are starting to nudge insurance higher. What used to be cheap, safe mountain living now carries a premium. Boise went from undervalued to overhyped to overcorrecting in under 5 years. If you came here expecting a safe haven and found out you bought near the top of a speculative wave instead, drop your story below. Boise is a case study in what happens when outside money waves a city like a flag, then leaves. Number 7, Las Vegas, Nevada. The city of risk finally met a bet it couldn't win. Vegas has always understood one thing better than anywhere else: probability. The house always wins, eventually. But this time the gamble wasn't inside the casinos. It was in the suburbs. During the last boom, Las Vegas median prices charged up toward $475,000. Investors piled into short-term rentals, second homes, condos marketed as Airbnb gold. For a minute, it worked. Tourism snapped back, stimulus money flowed, and everyone believed the party would never stop. Now by 2025, median prices in certain parts of the valley have slumped into the high 200,000s. Some segments are down as much as 60% from their frothy highs. What changed? Short-term rentals saturated. Too many similar properties fighting for the same pool of visitors. Occupancy slipped. Nightly rates dropped. Platforms tightened rules. Local regulations got stricter in some zones. Suddenly, that guaranteed 15% net return spreadsheet looked more like a break-even fantasy. At the same time, Water crisis fears grew more visible. Record heat made headlines. Utility bills during the summer turned into mortgage-sized invoices. Insurance pricing crept up as the risk models adjusted. The working backbone of Vegas, hospitality, entertainment, service staff, still doesn't earn tech city wages. They were already struggling to keep up with the run-up in prices. Even after this correction, many homes are still out of reach. You now have negative equity owners who bought in 2021-2022. Over-leveraged investors forced to discount or walk outer ring developments that feel half-finished and half-abandoned. Las Vegas has reinvented itself many times. But this reset is different because it cuts right through the housing optimism that powered the last cycle. If you're thinking about buying the dip here, you need to ask one question. Are you buying an asset or inheriting someone else's failed bet? Number 6, Phoenix, Arizona. The Sunbelt trade that backfired Phoenix was marketed as the smart escape. Cheaper than California, plenty of land, jobs, growth, warm weather, no snow, no basements, no problem. During the pandemic migration wave, money poured in from every direction. Median home prices in some parts of the metro ripped into the low 600,000s, fast forward to 2025. And many of those same neighborhoods have seen values chop in half, dropping back toward the low 300s. That kind of move isn't a soft landing, it's a hard reset. The pattern is the same. Investors overbought, builders overbuilt, buyers overpaid, rates reset reality. Entire subdivisions sprouted on the edge of the valley in record time. But you can't pour concrete faster than you create sustainable, well-paid jobs. Now, listings sit 4 to 6 months. Price cuts appear in waves, sellers throw in closing costs, buy-downs and upgrades just to move inventory. Meanwhile, the environmental cost stack hits harder every year, 110-plus degree days piling up. Power bills spiking in summer as AC runs nonstop utilities, raising rates to manage strain. Colorado River water issues forcing new building rules and restrictions. Insurance companies are not blind to this. Some policies now cost more cover, less, carry bigger deductibles, make it harder to claim for heat-driven or storm-driven damages. For the guy who stretched to buy a $550,000 house in 2022, today might look like this. House worth $350,000, mortgage locked at a high rate. Insurance up, taxes up, power bills up, wage growth flat. That's not home sweet home. That's a leveraged bet gone sideways. Phoenix still has sun, industry, and growth potential. But the blind Sun Belt always wins trade has been exposed. If you're watching this market, ask yourself, are you buying into stability or into a region that just discovered it's not priced for the climate it actually has? Number 5, San Francisco, California. When the ultimate can't-lose market finally did, for years, San Francisco was treated like a cheat code. You didn't have to understand the numbers. You just had to remember one rule. It always goes up. From the dot-com rebound into the app economy era, SF became the poster child for unstoppable real estate appreciation. Peak median prices approached 1.6 million then came. Remote work at scale tech, stock volatility, office vacancies, downtown rising crime perception, and a cultural shift away from needing to be in one expensive zip code. By 2025, median prices in many SF submarkets have dropped below $900,000. Some segments, especially condos, are down 50% or more from their highs. But remember, San Francisco started at a higher altitude, so even after that fall, it's still expensive, just less insane. The pain points. 1. The downtown hollowing. Remote work turned the financial core of the city into a quieter, sometimes eerie place. Empty or half-occupied office towers. Restaurants closed, small shops vanished. Less foot traffic, more visible disorder. That impacts surrounding housing directly. Who wants to pay top dollar to live near an office cluster no one uses? 2. The cost of simply existing as an owner. Property taxes on million-dollar valuations. HOA fees that can hit $1,000 per month in some buildings. Mandatory seismic upgrades, plumbing, elevator repairs, insurance that keeps repricing risk every year. Even if your value drops, many of those costs don't, so you've got people who bought at $1.4 million, now hold something worth maybe $900K, but still pay the same or more monthly fixed costs, and they're staring at a neighborhood that doesn't feel as safe, busy, or vibrant as it did before 2020. 3. Climate and fire risk in the region. Even if your specific neighborhood isn't in a wildfire zone, insurers look at statewide risk. Some carriers have simply exited or tightened up in California, and that squeezes everyone. San Francisco is no longer just an elite jackpot story. It's a case study in what happens when tech stops being a one-way escalator, urban quality of life slides, and buyers realize they don't have to live there to do their jobs. If you're still holding the fantasy that San Francisco real estate can never truly correct, 2025 is the year that myth died. Number 4. Myrtle Beach, South Carolina. The beach town built on spreadsheets, not foundations. From the outside, Myrtle Beach looks like a permanent vacation. High-rise condos, endless coastline, golf carts everywhere, tourists in every season. During the pandemic travel shift, investors stampeded in. They bought beachfront condos, Airbnb-ready units, resort-style apartments. The pitch was simple. People will always want the beach, you'll always be fully booked. Then reality hit. Since 2023, many segments of Myrtle Beach real estate have fallen 45% or more from their highs. For some condo owners, the story is even worse once you factor in fees. Here's the part most people ignore. You don't just buy the unit, you buy the HOA, the building, the risk, and every future decision of a board you don't control. In Myrtle Beach, that often means $400 to $1,000 in monthly association dues. Special assessments for elevators, roofs, pools, and concrete repairs, insurance costs folded into those dues that jump after every storm cycle. So you've got owners watching their property value slide, their monthly obligations rise, their rental income decline, all at the same time. Short-term rentals also got crowded. When every other owner is trying the same Airbnb play, occupancy and nightly rates naturally drop. Meanwhile, insurance pricing for hurricane and flood risk is climbing. Some carriers reduce coverage or raise deductibles. Local wages for service workers haven't magically exploded. Myrtle Beach turned into something dangerous, a market where the tourist fantasy masked investor fragility. If you ever thought a beach condo will always be safe, Myrtle Beach would like a word. Number 3, Salt Lake City, Utah, from hidden bargain to overcorrected experiment. Salt Lake City used to be quietly underrated. Good economy, strong community ties, access to nature, lower prices than the coastal West. Then the script flipped. Between 2020 and 2022, prices surged around 75%. Median value in some areas climbed from the low $300,000s towards $620,000. The reason was straightforward: remote workers fleeing high-cost states, tech and finance expanding, investors chasing yield in emerging Western markets. By 2025, a large chunk of that run-up is gone. Many neighborhoods now sit back in the mid-300,000s, winding back 40% or more from their peak valuations. Here's what that left behind. Owners who bought late in the cycle with 5 to 10% down, many now underwater or with barely any equity, a rental market that isn't paying what the spreadsheets promise property managers are offering. Free months, lower deposits, gift cards, no rent until date, promos. Just to keep occupancy high. Environmental risks don't get as much attention here, but they exist. Wildfire risk in growing foothill communities. Earthquake risk in the broader Wasatch Front, smog and inversion issues that hit certain seasons hard. Homeowners associations in new suburban communities can also be surprisingly strict. Fines for minor violations, restrictions on rentals. Additional fees over time. Salt Lake went through the full cycle faster than most. Undervalued, discovered, overpriced, correcting. Now residents and would-be buyers have to decide, is this buy the dip or step back and wait? If you're on the ground there, you know exactly how different the energy feels compared to 2021. Drop your take below. Number 2, Naples, Florida. When luxury collides with nature and math, Naples was never marketed as affordable. It was sold as aspirational: golf communities, guarded gates, designer shopping, perfect lawns, waterfront views. At the peak, average prices in some pockets hovered around $1.1 million. Buyers told themselves, it's a hedge. It's generational. You can't lose with prime coastal property. Then storms, literal and financial, hit. Hurricane Ian didn't just damage structures, it rewrote cost assumptions, flood repairs, mold remediation, roof replacements, seawall reinforcement, code upgrades. Insurance premiums in Collier County skyrocketed post-2023. For many owners, their annual premium didn't just creep, it tripled. That turns into $3,500, $10,000 per year, on top of property taxes, on top of HOA dues, on top of club memberships in some communities. Now combine that with home values falling by 40-50% from peak in certain segments. Many owners are realizing they paid 7 figures for something that might sell in the mid-6-figure range. While their annual carrying costs are higher than ever, that's the definition of being trapped by the dream. Almost every Naples neighborhood has an HOA or some form of association. Those come with monthly dues, special assessments for roads, roofs, pool houses, gates, rules that limit how you can rent, modify, or use your own property. It's not just a house, it's a long-term contract with other people's decisions. Naples still looks perfect from a distance. But under the surface, there's a growing tension between wealth that can absorb the new costs and comfortable households that can't. If you imagined retiring here, you need to factor in all of it: insurance risk, storm risk, rising dues, aging infrastructure, and the reality that those glossy brochures don't print the liabilities on the back page. Number 1, Palm Springs, California, the desert mirage that turned on its creators. We end in Palm Springs, the desert playground that became an Instagram backdrop, a mid-century fever dream, and a short-term rental magnet. Before the boom, it was the classic escape: old Hollywood echoes, poolside living, blue skies. During the frenzy, median home prices shot toward $1.2 million in some reports. Buyers from LA and beyond rushed in to flip bungalows, convert them to vacation rentals, market them online as desert oases at premium nightly rates. It worked for a moment, then 3 forces collided. 1, heat. Heat waves became harsher and more frequent. AC running almost nonstop, electric bills, spiking tourists starting to ask, do I really want to spend July here? 2, regulation. The short-term rental gold rush triggered a backlash. Permit caps in some areas, stricter enforcement fines for illegal rentals. Pushback from neighbors and local councils. If your entire strategy depended on endless, unrestricted nightly rentals, that foundation cracked. 3, insurance and utilities. Wildfire risk in the broader region pushed some insurers to retreat, reprice, or restrict. Premiums climbed, coverage shrank. At the same time, water usage is under tighter scrutiny. Fines and restrictions for overwatering energy costs keep marching up in a place where AC isn't optional. By 2025, median values in many Palm Springs neighborhoods have collapsed into the high 500,000s, a fall of 50% plus from the peak. Some short-term rental-heavy pockets are even worse once you factor in furniture and renovation costs you'll never get back. Lost rental income. Higher carrying costs. Palm Springs still looks incredible in filtered photos. But as an asset class, it exposed how fragile an entire city becomes when its primary business model is people with money, temporarily escaping problems created somewhere else. When the money stops escaping there, the math stops working. The bigger pattern, what this crash is really exposing. These 10 cities are different on the surface. Tech hubs, coastal retreats, desert escapes, mountain hidden gems, Sunbelt growth stories. But under the hood, they share the same weak points. Speculation outran salaries. Prices rose faster than local wage growth, turning homes from shelter into leveraged chips. Cheap money blinded people. Sub 3% interest rates made every monthly payment look manageable. At 7% plus, the same home becomes unaffordable. Fast. Insurance, climate, and maintenance were ignored. People bought the house and ignored the carrying cost stack. Insurance taxes, utilities, HOA dues, assessments, regulatory changes. Everyone believed their market was the exception. Coastal always wins, tech cities can't fail, Airbnb covers everything, people will always want sunshine. Reality just checked all of those slogans. This 2025 crash isn't just a graph, it's a recalibration of what risk actually looks like. What this means for you. If you're thinking about buying in one of these markets, stop looking at old Zillow charts, stop trusting slogans, start running full stack numbers. Insurance today, insurance if it doubles, HOAs plus possible assessments, utilities under stress scenarios, local job stability, population flows, in and out, not just in. Ask yourself, can I handle this if values drop another 20-30% and costs keep rising? If the honest answer is no, you're not buying safety, you're buying exposure. If you already own in one of these cities, you're on the front lines of this reset. This is the time for brutal honesty, not emotional attachment. Know your exit options, know your refinance options, know your worst-case numbers. It's not about panic, it's about position. If this breakdown helped you see the structure behind the headlines, take 1 second to like this video so more people don't walk blind into broken markets. Subscribe to across.us4. Share this with someone about to make a 6-figure decision based on vibes instead of math. Tell us in the comments, which city shocked you most? Which market do you want us to dissect next? And if you're in one of these places, what does it look like from your front porch, not from a chart? The 2025 housing crash is not the end of the world, but it is the end of blind faith. Make careful, informed decisions out there. Because in this cycle, the difference between homeowner and hostage is not the house, it's the homework.